Good evening, everyone. Happy Wednesday. Welcome to our Mississippi Alumni Association Homebuyer Workshop. My name is Jason Maida. I'm going to be your host and presenter for this evening. Thank you so much for taking time out of your busy schedules to meet with us. I know we're coming up on the holiday break next week, but really excited to be able to present this content to you. This is a class that we put on for the Mississippi State alum 4 times a year. So it's done once a quarter generally. This will be our last class for 2025, and then you'll see a full slate of classes available for 2026. Ultimately, this class provides you with really the framework for home buying. So understanding what the journey looks like to go from a classroom setting like this to actually going out and purchasing your home. Wherever you are in the country, we can help support you with your lending needs. So we can ultimately provide you the home buyer and education and resources like this. And then that'll obviously translate to the home buying process for you. Now, our organization, American Pacific Mortgage, or APM, as we're known also across the country, is the ninth largest lender in the country. Our team in particular focuses strictly on home buyer education and originating with our clients through different partnerships that we offer through schools like Mississippi State. So, and we're excited to bring this content to you. Our runtime for tonight's class is going to be about an hour. It is a very interactive session, and we are going to record tonight's class. So if you have to step away from your computer for a second or whatever, we will have a recorded version that'll be up in on our YouTube channel tomorrow morning. We're also going to send all of our signups the copy of all of our slideshow from tonight too. So if you want to refer back to that with some of your notes, you can certainly do this. We typically start these classes at 6 o'clock, whatever time zone we're in. Today we're in the Central Time Zone, so I know we'll probably have some people join a little bit late that might be on Pacific time or maybe Mountain time. But ultimately this will be recorded, so you can always go get a chance to go and look back at it. Now, our talking points for this evening look like this. We're going to go through the housing market and what's happening right now. I also want to spend some time talking a little bit about interest rates, maybe dispel a little bit of the myths on what's happening with interest rates. And we also want to talk a little bit about budgeting for home ownership and kind of what that looks like. We have some great tools that I'll share with you this evening. Talk a little bit about credit. How do we get ourselves prepared to take on home ownership and make sure that maybe we identify any areas of opportunity with credit? Talk about loan programs from a high level look. And then I want to spend some time looking at savings for home ownership. So I'm going to help you understand a little bit about the expenses that you'll need to kind of cover in the home purchase process. But I want to kind of help you prepare for savings towards those costs that you have in buying a house. We also want to talk a little bit about first-time home buyer programs. So depending on where you're at in the country, there should be first-time buyer resources available to you. As a nationwide lender, we can certainly get you connected with the right agencies that can support you with some first-time buyer assistance options. And then probably our most important part of tonight's class is to talk about the buying process. So after tonight's class, it's like, where do I go from here? Like, where are my next steps? And so I'm going to walk you through kind of the workflow of buying a house. All right. So that's our plan for the night. I see kind of some folks joining a little bit late. Totally fine. Again, we're going to have this class all recorded, so it'll be up on our channel tomorrow. So let's first of all talk a little bit about buying, as it doesn't make sense for me, because this is probably going to be one of the largest purchases you decide to make. And when we think about buying a home, I think when we compare what we're paying in rent today versus what it's going to look like on the housing expense side, we want to factor in some of the elements that really make buying worth it, right? Things like stability of housing payments. So I don't have to worry about a landlord that's increasing my rent costs. Many of our clients that are buying in today's market, they're paying probably higher than historical averages of interest rates, but most of those clients are going to be looking to refinance as the market improves with interest rates. So you may be buying today at a 6.25% rate, but as the market goes lower, there will be opportunities for clients to improve their monthly payment with a lower rate environment. Now, this is an asset different than, say, buying a car, because this generally will appreciate in value over time, right? So as I purchase my home at a set price, as the home goes up in market value, as I pay down my principal balance on my mortgage, the difference between those figures is called home equity. For most of us that are homeowners, that's probably our number one asset that we have, aside from maybe a retirement account or a 401k. That's probably one of the biggest assets that's working for us on a daily basis. And homeownership does have the opportunity to really transform families' lives. It can have the opportunity to really create generational wealth for families. There's also some tax benefits that come along with owning a home, potential tax deductibility of interest, as well as some energy efficient upgrade tax benefits as well when you make improvements to your home. So I would encourage you, as you're thinking about home ownership, we want to kind of factor some of those things into our calculations. To help you along with that, I wanted to share with you one of our home buying calculators. It's called our rent versus buying calculator. And we're going to provide, again, the slides for you from tonight's class. But I thought I would share with you this calculator because it's a great kind of launching pad for us in our discussion tonight. Because oftentimes when I work with buyers all across the country, they're like, hey, Jason, I'm spending $1,500 a month in rent. I don't think I can spend more than that. And so when we factor out their home purchase side and maybe only putting the payment at $1,500, it does limit their buying power. But when I walk them through a rent versus buying calculator like this, it helps to highlight some of the benefits of owning and may make them feel like a little bit more comfortable in pushing their budget because they're getting a better return on their asset. So here's what the calculator looks like. And just for our timing of tonight's class, we're going to kind of input everything. We've pre-filled everything, I should say. But I would encourage you after tonight's class, if you have some time, walk through one of your own scenarios yourself. Now, you'll see on this calculator link, there's also different options you can do. Affordability, buying down points for your interest rate, what my overall kind of standard payment looks like on a mortgage. So I'd encourage you to explore those when you have time. But we're going to spend some time looking at the rent versus buying component of this. So in this scenario, we kind of pre-filled in our build out. We assume someone's buying a house for $275,000, right? Now, the minimum down payment is 3% for a first-time buyer, which is noted here. That means we'd be financing 97% of that purchase price. And then we have an average interest rate, which is somewhere around 6.1 to 6.25, depending on our down payment and credit score. And then we have a 30-year fixed mortgage. So for most of us first-time buyers, that's going to be the option that we're going to select. And then we made the assumption that this particular buyer is purchasing next month. Now, that obviously will change with some of us in tonight's class, but ultimately that gives us a little bit of a start date. And then we're going to factor in mortgage insurance. We'll talk more about that in the latter part of tonight's class, which ultimately means when I put less than 20% down, I'll have mortgage insurance costs. We have homeowners insurance expenses, taxes. If I'm deciding to purchase in maybe a condominium community or maybe a townhouse community, I might have HOA fees. And then we also want to bake in the tax bracket that I'm in. So whether I'm in the 25% tax bracket, 32% tax bracket, whatever it might be, we want to put that into the equation because we need to understand that a mortgage could have potential tax benefits of mortgage interest that I pay on an annual basis. We also have the cost of maintaining my home, selling cost of my house, and then expected appreciation. Now, this appreciation does vary. And so we're talking across the whole country in our class. So it really depends on what part of the country you're on. Ultimately, housing prices do cycle over time, but 3% we're going to use as kind of our baseline number. And then on the rent side, we're going to compare that to somebody who's paying, let's say, $1,250 in rent with renter's insurance expenses and the cost of rent going up 2% every year. So what our calculator helps kind of frame up for us is like, first of all, what's the break-even point in when I'm going to have my home buying experience really kind of break even for me on my investment? And the answer is 4 years, which is a really short amount of time. So ultimately, I will be ahead and start now making money on my investment after 4 years. Now, if I was to kind of kick that out even further, let's say 10 years. So if I continue to just go and compare 10 years of renting versus 10 years of owning, I should say, I'm going to have about a $59,000 opportunity on the buy side instead of renting. And that's obviously a significant amount. That is an asset that's working for us because we have to factor in equity appreciation, tax benefits that come along with owning a home. And so really that's truly the magic in home ownership. When we come to from an investment perspective, not only do we have the opportunity to create better affordability for most of us in most parts of the country, but we have an asset that's working for us. And so I would encourage you guys, when you have some time, take a look at that calculator. The link's all in the slides, and you can kind of just run through your own scenarios. And I'm certainly more than happy to help you with that as part of our consultative process. Now, as we think about building our budget for homeownership, we also got to think about the entry point for homeownership in what the housing market is doing. Now, this is the Mississippi housing market. You can see kind of what's happening. A lot of that is kind of cyclical or seasonality in the markets because homes are staying on the market a little bit longer. You can see almost 2 months median days on market. Quite honestly, not different than other parts of the country, though, too. If you look at Florida, Texas, Colorado, Georgia, you're seeing markets that have higher than expected inventory levels, which does mean it's a better buyer opportunity for many of us. You can see the Mississippi housing market kind of still remaining fairly level in price, not a lot of variance there, which is pretty typical over the last couple of years. Ultimately, the housing market in Mississippi remains very affordable. Not to assume that all of us in class are going to buy in Mississippi, but I will say, if you look at most parts of the country, this time of the year, we do generally see a slowdown in the market. However, I think as we get through the winter months, I don't believe this is going to be your typical slower housing market because there's a lot of pent-up demand in the markets for what we have now is interest rates. And so everybody's been waiting for interest rates to go lower. I think everybody wants the perfect combination of lowest priced home, lowest possible interest rate. Probably not going to happen. That perfect storm rarely happens, but ultimately, your entry into home ownership will be dictated probably by what interest rates are doing, because ultimately that's going to drive some of your monthly payment costs. Now, good news here is interest rates are going lower. It's not a question of if interest rates are going to go lower, but it's more of a when. And we're really watching closely what the Federal Reserve and their commentary on what they're going to make as their next move for an adjustment to the federal funds rate. So there's one more meeting left on the 25 calendar with the Federal Reserve. And right now there's about a 50-50 shot that the Federal Reserve is going to cut rates in December. So we're watching really carefully what their move is. There's two kind of major measurements that the Federal Reserve is looking at. What's the labor markets doing and what's inflation doing? Now, we just reopened the government on Friday. And so a lot of the data that we would generally see that moves the markets hasn't been available for the last, 40 days. Plus, and so now we're starting to see some of that data come out, or it hasn't come out, but we have one big data report coming out tomorrow, and then we have another inflation report coming out on Friday. So we're watching that really carefully. The misconception that you'll hear in the news is that when the Federal Reserve says, "Hey, we're cutting rates by 0.25%," people think mortgage rates go down that day. It's actually a little bit different. Mortgage rates actually will drop in anticipation of that rate cut. So the last rate cut we saw rates already going lower. But after we saw some of the commentary from the Federal Reserve, rates actually kind of ticked up a little bit. So, this will be kind of a preview. Mortgage rates will be a preview as to what the Federal Reserve is going to do. And as we get more clarity on their move, you'll start to see that volatility or that reduction in interest rates. But it still remains very volatile in mortgage interest rates. Here's kind of our path over the last 12 months of interest rates, and you can see kind of where we're hovering today on the 30-year fixed rate. This is a 20-year snapshot of rates. And I just like to point this out for our class to show, kind of the major economic crises that can influence interest rates or that we've kind of gone through. This is obviously the housing crisis here. This is the pandemic. And then you can see, the lowest level of interest rates we've seen on the 30-year fixed touching 2.5%. I like to also point this out because I think it's important as future first-time buyers to have a realistic expectation of the market that rates are probably not going to go back to 2.5% unless we've seen a major global crisis like we did during the pandemic. You should expect interest rates to be, depending on when you buy, in the high fours to low fives, or if you're going to buy sooner than that, probably the mid fives to high fives, depending on when you do make that move to home ownership. But ultimately, I think it's important to understand the interest rate cycle, and interest rates during the trading day will change by the minute. So this is a very fluid market right now. Interest rates have different elements that also make up the overall cost that you receive as a consumer. It takes into consideration credit score and eligibility, the type of program that you're going to select, what your down payment might look like, how much you decide to borrow. You have the option as a buyer to pay additional expenses out of pocket. We call those points. Not really recommended by most of our buyers that I consult with, but ultimately what a point is, it's 1% of your loan amount that will equate to about a 0.25% reduction in interest rate. So not a great investment because it breaks even in about 3 to 4 years. And then the term of my loan can also influence my interest rate. So if I do a shorter term versus a standard 30-year term, then what we'll do is we'll see a lower interest rate offering. But ultimately, we're going to find the best product that suits your goals and objectives for homeownership. Speaking of term, I know there's a lot of talk in the news about the 50-year mortgage and how that creates better affordability and stuff like that because it lowers the payments. I know there's a lot of chatter around that out there in the news outlets. We don't really have a stance at this point on the 50-year, other than obviously when you think about taking a mortgage from 30 years and expanding it over 20 years, that significantly raises the borrowing costs of a consumer. Because while we want to create better affordability on a monthly basis, we also intend to have a situation where a buyer ultimately owns their home and not paying on a mortgage forever, right? And I think the 50-year obviously does that. So it still remains to be seen where that goes. But I think as a buyer looking into the markets, that option would not be for everybody, especially for someone that has the intention of paying down or paying off their mortgage. Now, credit goes into what an interest rate will look like, as well as the product selection, in some cases, mortgage insurance. Now, every product has a minimum credit score. There's FHA has a minimum credit score. Fannie Mae or Freddie Mac, the conventional product it's gonna remove this minimum credit score. We don't have this updated on our slides quite yet, but ultimately that minimum credit score is going to go away on the product. They have a risk scorecard that we're going to kind of move to, which really doesn't change things that much. There's the VA product. And then for those of us that want to buy in more rural areas, there's the USDA loan. We're going to talk more about programs in just a minute, but just want to give you a sense of the minimum credit scores. Now, when we think about the three agencies that we review in lending, we look at credit for Experian, TransUnion, and Equifax. Now, we do take the middle credit score of all three agencies reporting. So if my highest score is 760, my middle score is 740, and then my lowest is 720, we're going to take 740 as the credit score we use for qualifying purposes, right? Now, if I'm going to have my partner that's going to join me for qualifying on the mortgage, and they have slightly lower scores, maybe they're 700, 680, and 660, their middle score is 680 versus my 740. So in that case, we would take the 680 as a score for reporting and determining the eligibility for a product. Now, in looking at a credit score, when we have events that impact our credit score, it usually is in the most recent 12 to 24 months. So, for example, I was talking with a client just a few hours ago, and they unfortunately had a billing issue on their Capital One credit card, and it really dinged their credit score. Because that's happened in the most recent 12 to 24 months, they're having a really big impact to their credit score. Now, hopefully we can get some resolution to that. But as we get further away from that event, then and we can show on-time payment history, then we'll start to see lift in my credit score over time. But really in the most recent 12 to 24 months, our credit score is going to feel quite a bit of a drag from that, unfortunately, that negative reporting. This matrix that I have up on screen shows you how long negative items will be with you on your credit report. So you can take a look at that. You know, that late payment that I referenced in that scenario, that is technically going to be on my credit report for 7 years, but the impact to my score per se is going to be in the most recent 12 to 24 months. Now, there are three different models to credit scoring. There's a credit card model, there's an auto financing model, and then for home financing, there's a mortgage model, right? So those of you that are kind of managing your credit accounts through Credit Karma or some of the other outlets that are available to you, even through like Discover Card or Amex or whoever you're using, they're using a credit card score. And that's going to have a different scorecard than you will see on the mortgage side of things. So to identify some opportunities for you as you're preparing for home buying, I thought I would walk you through just the weighting of a credit score from a mortgage perspective. And it looks like this. So 15% is going to be how long I've had credit. So the more mature my credit file is, the better my credit score is probably going to be. 20% is going to be how much new credit am I trying to access? Am I opening up a bunch of new accounts? Do I have new hard inquiries on my credit? Those will deteriorate your credit score. We really want to avoid hard inquiries, especially in a 6 to 12 month period of time. Now, one of our unique kind of approaches to helping our buyers with their home buying solutions is we only start with a soft credit check when it comes to designing your home buying options. And the reason why a soft check is so much more effective is because it gives me insight to your eligibility for a mortgage product, but it doesn't impact your credit score. And so we can, pre-approve a client with a soft credit score right away and not have to have the impact of a credit inquiry on the client's scorecard. Now, at the same time, there is a 30-day window of time for hard inquiries that allows buyers for home shopping as well as auto shopping to be able to get as many inquiries done in a 30-day window of time. It's the equivalent of one credit inquiry hit to your score. The next component is amount owed. That's probably the biggest area of opportunity for most clients because we're looking at revolving credit debt. It's specifically looking at your credit limits that you have in aggregate limits versus your aggregate balances. So if I'm at $10,000 in limits, I have $8,000 in balances. Right now, I'm at 80% utilization of credit. If I'm operating at that high of a level, I'm probably seeing some deterioration in my credit score. So my recommendation to our clients would probably be let's try to move below 50% utilization of that credit limit. Now we'll start to see a bounce back in my score. The optimal level is 10% or lower. Now, if you're trying to manage down credit card debt, I want to give you a quick tip to take away from tonight's class. And that is when you look at your credit card statements, you have a billing cycle statement date, and then you have a due date. If you can change your practice or your approach on your credit card management to pay down your credit cards or simply pay them off before the end of the billing cycle date, what happens is when that billing cycle date closes, the information on your account gets set out to the three agencies. So if you can pay that account down before the end of the billing cycle date, then you're going to have a much more improved credit score, lift up that credit score, especially as you're preparing for, figuring out your home buying options. Last component is payment history. That's essentially how have I paid my debts. If I've had any late payment challenges, they're rated as 30-day lates, 60-day lates, and then 90 plus day delinquencies. So the more severe that late payment is, the bigger impact I'm going to have to my credit score. Now, as we think more about credit, I want to kind of spend a little bit of time talking about student loans. I don't think there's a day that goes by that I'm not consulting with a client and we're not having a conversation about student loans because student loans are kind of in a weird place. There's some transfer of servicing going on. There's forbearance, not forbearance, active repayment, not in repayment. So, want to just kind of give you some insight as to how we look at that from a lending perspective. So, if you're in repayment, that's pretty easy. You're going to basically be qualified at whatever payment you're paying today. So, if you have $75,000 in debt, and let's say you're paying $250 on a savings plan today, we can use that payment right away. Now, where it gets challenging is many clients are in a forbearance plan because of the litigation of federal student debt, and so they don't really make a payment or they went off of plan, right? So if you have $75,000 with that same student loan debt, if you're going to try to qualify for a conventional loan, then by default we have to count 1% of the balances for the payment if we're doing a Fannie Mae loan. If you're doing an FHA loan, which is a federally insured loan, then we count 0.5% of the balances as your monthly payment. So that can change qualifying. So even if you're not making payments today, that's great. That obviously saves you money. But if you're trying to qualify for a mortgage, we do have to institute or implement, I should say, a minimum payment for qualifying purposes. All right. Now we're going to talk a little bit about loan programs because ultimately the student loan guidance that we have to give to our clients comes out of the loan program guidelines that we have to adhere to as a direct lender. And so I want to spend some time looking at some of the products that are available to you as a buyer. And I want to just give you kind of a high level look. And many of these terms that I share with you, you've already heard before, but I thought I would kind of just put a little bit more context around it for you. The first loan is a conventional loan, which is a Fannie Mae and Freddie Mac loan. For our first time buyer, it's a minimum down payment of 3%. You see our minimum credit score, at least that we have as of right now, that is changing. And then there's a conforming loan limit, which today is 806,500. That is actually going to go up to 819 for 2026. Now, there's other areas of parts across the country that are called high cost of living areas, where you can go up to higher loan limits, like $1.2 million, but it does elevate the minimum down payment from 3% to 5%. And that conventional loan, we can think about more of a Fannie Mae and Freddie Mac loan. You are going to start hearing Fannie, or you have probably heard Fannie and Freddie in the news about kind of getting out from under conservatorship from the U.S. government and privatizing them. So we'll see where that conversation goes. The next loan is an FHA loan. That's a government insured loan. Minimum down payment you can see on screen of 3.5%, minimum credit score. And then the maximum loan amount that we have here varies by county. Both the FHA loan and the USDA loan are both government insured loan. The difference is USDA allows someone to buy in more of a rural area with a zero down payment option. You can see the minimum credit score there. And that loan amount also changes by the location of the property. Many areas in Mississippi are considered USDA eligible, but it does have to meet the location qualification. Also, there is a maximum income by household size. Now, both FHA and USDA, since they are government insured loans, about 4 or 5 months ago, we did see some residency requirement changes with these products, unfortunately, which basically states that you have to be a permanent resident to access these programs. Okay, so that's part of the guidelines. Conventional, you can still be a non-permanent resident and still have access to those programs. And then the jumbo loan, not common for our first-time buyers, but allows someone that's going to be purchased beyond, say, the agency limits of 806,500 to get access to home ownership, but it's going to come with it a higher level of down payment and higher asset requirements. And then for our veterans that have eligibility for the VA home loan, there's a zero down payment option, really no maximum loan amount. And of course, you have to have eligibility under the VA product. All right. Now that you've learned a little bit more about loan programs, I want to dive a little bit deeper and talk about PMI or private mortgage insurance. But I also want to talk about MIP, which is government mortgage insurance. because there's a lot of misconceptions around that. And I just want to see how that, share with you how that can impact you as a buyer. So I want to give you kind of a look into both private mortgage insurance and mortgage insurance premiums. So PMI is based upon three elements. It's down payment, it's amount finance, and then it's what my credit score is. So the higher I can get my credit score, the more I'm going to put down, the lesser cost I'm going to pay from a mortgage insurance perspective. Now, on a conventional loan, PMI does have a cancellation option. Once I reach 2 years in my home and have achieved 20 to 22% equity, I can apply to have the mortgage insurance canceled. Now, one of the things I see online with some of the searches that our clients are doing is just the cost of mortgage insurance. It's not as bad as you might think. Because if I have a 740 credit score and I'm going to finance $300,000 with a 3% down payment, my mortgage insurance cost is estimated at $92 a month, right? Some of your calculators that you find online will have a much higher premium. So again, it is based upon credit score, down payment, and amount finance. So the higher I can lift my credit score, the more I can put down, the better my cost will be with PMI. Now, the other side of it is FHA mortgage insurance premium, which is a little bit different because whether I'm a 620 score or a 720 score, the mortgage insurance is the same. It's 0.55% of my loan amount for my monthly premium. And then we basically take the total loan amount times 0.55% divided by 12. We come up with a dollar figure. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. And that gets added into my total amount finance. Now, different than the conventional loan, FHA loan mortgage insurance can only be canceled if I decide to refinance out of my loan. So many times our clients will use FHA as an entry point to home ownership. As I improve my credit profile, maybe I save up a little bit more, maybe my increase my equity in my home allows me now to refinance over into a conventional product. Here's the calculation for payment on FHA, same $300,000 loan amount. You have your upfront mortgage insurance, which gets added into the amount finance, and then you have the monthly MIP of $137.50. So clearly the cost structure is different on the FHA loan or higher than the conventional loan. But I think it's important for our class to understand that not everybody qualifies in a conventional product, but FHA can be an alternative solution to get access to home ownership because FHA will be a lot more flexible from a qualifying perspective. All right, I'm going to take a quick pause there. Any questions from our audience? And I forgot to mention as we started our class, you can use the chat feature in Zoom or the Q&A, and I have both windows up, so I'll be able to monitor any questions you might have. So if you do have any questions, you can drop those in. I'll also carve out some time at the latter part of our class to take on any questions you have. All right, let's talk a little bit about income for qualifying. I get a lot of questions around, is my income eligible? Do I make enough money to qualify? That kind of thing, right? I wanted to pass along, first of all, though, some of the documentation requirements for qualifying for a mortgage. So you can see that noted here. Usually we're going to see the last 2 years of historical data for your income. And then in qualifying your income specifically, we do have to put together a 2-year work and or education history. So, if I just graduated from Mississippi State in the fall and I just started my job recently, I only have like a couple months on the job, right? Or I'm getting ready to start my job, then as long as I can piece together my start date and my educational background at Mississippi State, then I have my 2 years of history made up. Okay. Now, even in a case where I'm new on my job and maybe I'm getting ready to start a new job and I want to count that new job income for qualifying, we can use that as long as we put together a 2-year work history. Where it gets a little bit trickier for our clients is that if I'm trying to use a variable compensation part of my compensation, right? So let's say I get commissions or bonuses or restricted stock, or maybe even overtime for my job. In that case, I do have to show I've been with my employer for 2 years in order to count that income. Because ultimately, what an underwriter does is they take that income, they see what the 2-year historical looks like on it, averages it by 24 months to figure out what we can use from a monthly perspective. All right. And then if I'm self-employed, that means I'm filing taxes as a sole proprietor, 1099 basis. Then I do have to show that I've been had my business for at least 2 years. All right. If I also have a situation where, let's say I have 2 employers that I work for, maybe I work for one for 30 hours a week, another one for another 24 hours a week. In that case, because I don't have technically full-time status, I have to show that I've been working for both employers simultaneously for the last 2 years. Even if I'm working a side job, maybe I work for Uber or Lyft on the side in addition to my full-time job, I have to show that I've been doing both jobs for the last 2 years. All right. And then the last thing I want to kind of touch on is other sources of income. So let's say I have a partner that's contributing to my household income. but is electing not to be on the application for whatever reason, I can't count that income that my partner's contributing unless they do want to be part of the application. So if they're paying me $500 a month for rent or paying their portion of the bills or whatever the case may be, I just can't use that income when it comes to qualifying purposes. Now, sticking with the theme of income, we also look at expenses versus income. We call this calculation debt to income ratio. It essentially looks at, what do I have in outgoing expenses today? Credit cards, personal loans, anything of that kind of stuff, right? Student loans. And then it compares to my pre-tax income on a monthly basis. But I also need to add in my projected housing expense. So if I have, my principal and interest, which you can see the calculation here, principal and interest, property taxes, homeowners insurance of my new home, plus private mortgage insurance if I'm putting less than 3% down. Maybe I'm buying in a association community, but let's say that payment's $2,500 a month for my new house, and I have today $500 of outgoing debt, and I'm making $8,500 a month. Then what our debt to income ratio calculation tells us is that 35.3% of my pre-tax income is going out to my expenses, including my new house payment, right? And from a guidelines perspective, when we qualify for a mortgage, we can't have that percentage be more than 45 to as high as 50%. For most of our clients that I consult with across the country, that sweet spot is about 33 to 36%. Like that's kind of the excellent or the comfort zone, if you will, for most of our clients. But you can, from a guidelines perspective, go as high as 45 to 50%. All right. Now, please keep in mind, that is a gross figure that we're using to calculate. And I always like to kind of share with clients is that, when you think about affordability around home ownership, right, you're going to be looking at your net income. And there's probably some debts that we can't see when it comes to building your home buying plan. So as we kind of work with you and consult with you on home buying, we want to obviously design an option for you that's one, affordable, and two, is sustainable for you over time in case there are economic challenges that you go through at some point in time. Now, the last component to building what we call as a home buying plan is to think about what I have to save for home ownership. Now, there's a few different expenses that we have to consider beyond down payment when it comes to buying a house. Not only do we have that minimum 3% down payment that we looked at in our loan products segment, but we also have to save up for things like closing costs, which can be somewhere between 2 to 3% of our purchase price, depending on where we're going to buy and what we negotiate. There's also a thing called prepaid items when it comes to buying a house, prepaid interest on your mortgage, prorated taxes for your new home that you're buying, all those things that come into home ownership and the expenses that you have to put out of pocket. Now, savings for home ownership can be really challenging for some of our buyers. And so I'm going to walk you through a savings plan in just a few minutes. But before we do that, I wanted to share with you some of the documents we'll generally ask for to verify what we've already saved for home ownership. Of course, checking and savings accounts can be eligible. We just can't use cash deposits. Any deposit that's untraceable, we have to make sure that's at least seasoned 60 days. We have retirement accounts that can be used, investment or brokerage accounts can be used. We always encourage you, though, talk to your tax or financial advisor before you access those assets because we don't want to create any type of tax or issue or lose appreciation in the markets. And then gift funds can also be used. That's where a family member is helping contributing towards your out-of-pocket. Gift funds do not have a seasoning requirement, but we do have to document kind of a paper trail of the use of those funds. Now, when we look at savings for home ownership, again, that's going to be probably a bigger challenge for some of our buyers because, maybe I'm just new in my career and I'm trying to get my debt settled. Maybe I just making my living arrangements in my rental, stabilized or whatever the case may be. So savings can be a challenge, but I want to walk you through a really simple approach to savings that can help you on that path towards home ownership. So let's give a kind of a what if scenario. Let's say today I'm paying $1,500 a month in rent. But after doing your consultation with me, we're like, okay, once I get things together, I should be able to afford $3,000 a month from a mortgage perspective. Well, right there, we have about a $1,500 improvement, right? So what I would encourage our client to do is if I can really afford $3,000 today for a mortgage or in the future, but I lack the savings today to be able to purchase, what I would encourage our clients to do is let's start saving today like I'm actually making that $3,000 mortgage payment. So on December 1st, when I pay my landlord $1,500 a month, I create that habit or discipline that I'm going to transfer another $1,500 directly into my savings account without even thinking about it. Before you know it, by the end of 6 months, I got $9,000 accumulated. End of the year, $18,000. And that doesn't even consider compounding or interest accounts like high yield accounts that you can also gain some money on as well too. So It's a very simple approach to savings, but it's a very effective one. We've had lots of clients that have implemented stuff like that. In fact, we had a client just 2 weeks ago got the keys to their house, putting a plan in place just like that. And I would encourage you to kind of think through that. And certainly we love to be able to partner with you and kind of help you figure out what a savings plan might look like for you as part of our consultative process. Now, savings again is a challenge, but there also are first-time buyer programs all across the country to help support you with the resources needed and maybe close down the gap a little bit from what you have currently available to what you need to purchase your home. So in Mississippi, there's a Mississippi housing program that allows you to get $6,000 to $10,000 in assistance, which is basically a low interest rate loan, or sorry, a zero interest loan. There's also special incentives or programs for teachers. There's also a mortgage credit certificate that allows you to get a tax credit for the percentage of interest you pay. So those can be really great resources for you. Now, without knowing where everyone's going to purchase, depending on what state you're in, there is probably some type of HFA or housing finance agency in your respective markets that has a similar program. I love to be able to get connected with you after tonight's class if you do have some questions on specific programs that can help you there. Generally, these programs will target low to moderate income households to help you with that. And that is measured differently in different states, but like low income is considered someone less than 80% of the median income. And then moderate income has different definitions. It can be 100% of the median income to as high as 150% of the median income. Now, another product I just want to share with you that does not have income limits is our internal APM pathway program that provides up to 3.5% or 5% in assistance funds for your home purchase. And what that is paid back on a monthly basis as part of your mortgage, but it allows a little bit more flexibility for the first-time buyer in getting some additional resources. All right, so that's a little of a look into the first-time buyer programs. Now, as I mentioned, as we're kind of launching in tonight's class, I wanted to have everybody have a chance to kind of talk through the workflow of buying a house. So after tonight's class, hopefully I've given you a few things to think about around home ownership. And as you're pursuing this financial goal, I wanted to kind of give you a look at what's the workflow of buying a house? Like, where do I go from here after tonight's class? Well, after tonight's class, I'd love to be able to get connected with you for a free consultation. That's where I meet with every client that's interested in meeting with us to do a 30-minute virtual session where we get a chance to design some home buying options for you and figure out what this is look like. What are some areas of opportunity for you in pursuing homeownership? Now, the output of that session that you do with me is to have you pre-approved for your home purchase. Now, whether you're going to buy in 2026 or maybe it's a longer timeline, at least you have a baseline for your eligibility. Now, a pre-approval gives you the ability to go out and start looking for homes. The pre-approval is usually good for 60 days. It can be recertified at any time. So you might meet with me next week and say, hey, Jason, I'm going to start looking for homes by the end of the year. Great. You might meet with us and say, hey, you know what? I'm probably going to start looking in the spring or maybe the end of 26. That's okay too. We just want to help create a baseline for you for eligibility so you understand your options and just really get a good idea of goals for home ownership. Now, if you're ready to start looking for homes, then that moves you to step 2, which is the house hunting phase. That is something where we would encourage you to check with a realtor or partner with a realtor in your local market. But now you start kind of looking at homes a little bit more seriously online, and maybe you start identifying a few communities that work for you and start going out and physically looking at homes. Now, once you've identified a home that works for you and fits the budget, matches the community elements that you're looking for, then you would probably present an offer to a seller through your agent. Now, if that offer gets accepted, then we continue to move down that path. Now we're at step 3. That means you have an accepted offer with a seller. And now kind of that's where the action items start beginning on your side, because once you've agreed to a seller, that contract has timelines in that. Usually it takes 30 days from accepted offer to actually getting the keys to your house. Now, it does vary in different parts of the country. Sometimes it's 45 days, sometimes it's 60 days. Sometimes it can be as short as 14 days, believe it or not. Now, once your offer has been accepted, you're going to get a call from me and say, hey, congratulations, you did it. Your offer's accepted. And then now let's talk a little bit about next steps, and let's get you scheduled for a follow-up virtual session so we can go through your financing design elements and make sure that you feel comfortable with everything. Understand a little bit more about your out-of-pocket expense, what assistance programs match up best for you, and ultimately kind of what your monthly budget looks like on this house. Now, we'll certainly have some of those conversations going leading up to your offer on this home, so it won't be something that you're not going to understand going into it, but ultimately we kind of fine-tune everything at a follow-up video session. Now, as a buyer in the contract, you'll have some requirements like making an earnest money deposit for your home. In most parts of the country, it's 1 to 2% of your purchase price. It does count towards your total out-of-pocket expense. And in most parts of the country, we also have contingency elements to your contract, which basically states that you can get and do investigative work on the house and have your deposit protected in a certain span of time. There's appraisal contingencies to get the house appraised to make sure it's worth what you're buying it for. Inspection contingencies to make sure there's no challenges with the house, foundation, roof, sewer, whatever the case may be. And then, of course, there's a loan contingency to make sure your loan approval is in place. And so that all provides protections to you as a buyer so that as you're doing your due diligence on this property, you feel comfortable, kind of pursuing the next steps in the process. So as we get through contingency, we continue to move down this timeline. Then we move to step 4, which is some of the administrative functions of the loan, verifying your employment, verifying assets, making sure that some of the admin work is done on your first-time buyer program. And then I kind of talked a little bit about this earlier about interest rates. Now, interest rates move by the minute during the trading day. Now, once you're under contract with a seller, then we start talking about strategy and when the timing of locking in the interest rate, because interest rates change really quickly. So we want to make sure we kind of strategically approach locking in your interest rate at the lowest levels possible, given the time duration of your contract. Step 5 is going to be the loan approval phase. That's when your loan has been approved officially by an underwriter. At that time, now you'll receive a checklist of items from the approval, and our team will work with you on clearing the conditions of that approval. Once that's all done, we're going to give the okay on your contingency removals, and then it will create a final disclosure process. Now, all of the disclosures provided for you in lending are all done e-signature. There's your initial disclosures that are done within 72 hours of your contract. Then once your interest rate is locked, you get another set of disclosures. And then at step 5, you get your final closing disclosure to start your 3-day cooling off period before the very final stage, which is closing your loan. And that's when you'll sign documents in person with the public notary. That's really the only time, other than investigating your home or being out there to check out your home, that we'll need you in person. You'll generally meet with an escrow officer, title officer, maybe even an attorney, depending on what state you're buying in. That process will take about an hour or so. You'll also deliver your final funds on that signing day. And then documents will get recorded with a county recorder's office. That also includes, of course, the financing that we're providing you as well. But documents get recorded with a county recorder's office on that day to transfer the ownership to you as well as the deed for your loan. We'll get confirmation back from the recorder's office saying everything has been completed. And then I get a chance to make my favorite call of the day, which is to say, hey, congratulations, you did it. You're now a new homeowner. And I got a chance to make one of those calls bright and early this morning. And it's the best part of my day by far, because it truly is a huge accomplishment. It is achieving a major financial milestone for you. Our relationship, though, doesn't stop there with our clients. We're always kind of staying connected with you, whether it's question on billing or property taxes. Part of our aftercare, we're also watching what the markets are doing and if there's an opportunity to refinance your home. So you'll have tools like our HomeBot system to manage your equity position in your home, and of course, tracking what interest rates are doing, and of course, staying connected with you throughout the year with any changes you have financially that we can help you with. So that's kind of what our buying process looks like. And obviously it's a very high touch experience for us. It does start with our consultation that we offer to you. It's a free session that we do. You will build an online profile with us. We only do a soft credit check, and then you'll upload requested documents and then use our scheduling system, which you can see here, to book your free consultation appointment. So I'll meet with you individually for 30 minutes just to go through your product design. Now, you may have some questions after tonight's class that don't get answered during our Q&A session. We'll certainly answer those questions for you in an introductory call, or you can just feel free to reach out to me at any time. This is all of kind of the aspects of a consultation with you. It looks very similar to what you've experienced tonight in our home buying class, but we want to talk a little bit about budget and where do I want to buy and what do I want to buy, and what resources do I need around me to successfully navigate the homeownership waters. Okay, so that's all part of the consultation service. And our process is very high touch, which is very different than a lot of lenders that are in the same marketplace. But we also do understand to leverage technology. So you'll see our mobile platform that allows you to start the process application-wise there. You can find different calculators that you can use in your home shopping. Also follow the progress of your financing. We also, in our HomeBot system, also leverage some AI tools as well too to make things as seamless as possible for you. One other thing I wanted to point out to you, part of our partnership with Mississippi State Alum is we also discount our services to you. So some of our closing costs that we have as part of financing for you as a Mississippi Alum membership benefit, we actually discount our services by $750. That doesn't have to be just for a home purchase. If you have a friend or family or coworker that's also refinancing and part of the Alumni Association, we'll also discount our services there. And our class is being recorded tonight, so I encourage you to share that with friends and family and coworkers. But we also teach other live classes. There are other partnerships that you can see on screen. We're going to teach over 10,000 folks across the country the power of home ownership. And so we know we would love to have anybody that you think might be interested in learning more, have them attend one of our free classes. Here's all of our contact information that you can see on screen. Feel free to reach out to me with any of those contact platforms. And we do love what our clients say about us on social, whether that's on Instagram or Facebook or in our Reddit communities. A lot of great experiences out there. We really take this as an opportunity to serve in our local communities. And I think what our clients say about us in our communities really says that. And so we're really proud to, provide educational resources like this and then help you in that journey towards home ownership. Well, that brings me to the end of class. I know we're a few minutes ahead of schedule. Some of us may have joined late, but not to worry. All of our class has been recorded, and we are going to send all the presentation material out to you tomorrow morning. And so that'll be available to you as well. But I do want to open it up for any questions that you might have. So I'll go ahead and I have the Q&A up in chat. So feel free to drop any questions in. I did have somebody ask a question. And I think Ken, one of my colleagues, have actually just answered it, but we do have another class tomorrow specific for California, for a specific California program. So that will be a live YouTube class tomorrow. So I don't know if anybody in this session is in California, but we're going to be offering that on YouTube. So yes. All right. Any other questions from our audience? Okay. All right. Well, I hope you guys enjoyed tonight's session. Hopefully you've taken one or two things away that can help you on that journey towards homeownership. I'd love to be a partner for you in helping you reach that financial milestone. And especially this is a great time of year to be thinking about that because, hey, we're getting ready to jump into 2026 in less than 60 days. And so if I didn't get a chance to connect with you before the end of 2025, I wish you all a wonderful holiday season, a prosperous and healthy new year, and hopefully we get a chance to connect soon. Have a good night. We'll talk to you later.